Uh, this is a deflationary shock event that would hit and would create a deflationary spiral. It was started in Europe. It was spread to the banking system of the United States. It would be uh, uh, a financial catastrophe. Now, the central bank has already said what they're going to do, and they're going to do exactly the same thing as they did back in 2008. 2008 was the same sort of a thing. It was a deflationary shock event, except there's a difference this time. They've shot their bullets. They've taken interest rates down. They've used quantitative easing. They've used monetary policy and normal monetary policy. This time, there's only one thing left. That's hypermonetization. And if you've listened to my videos, you know what I'm talking about when I refer to hypermonetization. It's monetizing like quantitative easing, except more, bigger, better, brighter. And also, then there's helicopter money, which is like quantitative easing, but it's unsterilized. And so what you have is you have this hypermonetization that is the effect would be, and this is the only thing that they can do to fight a deflationary shock event like the European Union breaking apart. The only thing that they would have left to do is hypermonetization.
Hello, ladies and gentlemen. Good evening, and welcome to the show. You guys see what the markets did today? Oh my gosh! Uh, I've been talking for years about something I call a deflationary spike event. Why I call it a deflationary spike event? It's kind of almost the markets. It's a sudden downturn that's like a spike being driven into a piece of wood. It just goes down. And it's deflationary. I call it a deflationary spike event. And on this long road that we've been on, that's been over 100 years, leading toward hyperinflation, where we saw the dollar lost 98% of its purchasing power. This process is on an exponential function, and at a certain point, I've been expecting this for a long time, a sudden sharp downturn that's going to change. Everything's going to change with a deflationary spike event. Is this it? Big question mark. Several times now I've been caught off guard with this market. I call it the Teflon market because it seems like no matter what happens, bad news, it seems to have rise sometimes when bad news, and this has been a very difficult market to predict. But I've been calling for a deflationary spike event for a long time, and this is the last move. It's the end game. The deflationary spike event is the end game. What happens is it's a sudden deflation. They can't allow that in the system. They can't allow it to progress too far. Now we're right on the edge here with this. They can handle these losses that's happened now if the market in the next several days turns over and starts to go back up again. But we're at that critical juncture right now in this. With a drop in the Dow of 2,231 points today. That is enormous. If it goes down any further, if we see a progression downwards and this, they're going to react. And that reaction is what separates the difference between what I call a deflationary spike event and a market crash. That reaction of the central banks to go back to accommodative monetary policy. And what does that mean? What are they going to do if they go back to accommodative monetary policy? Well, what they're going to do is they'll start by trimming interest rates. They might even do an emergency rate cut. That's first. Never underestimate the power of of lowering interest rates. It's very powerful for the economy. This is the rate you borrow money at. And, if you lower that rate, bring it down towards zero, it makes it a lot cheaper to borrow money. And then the second part of that is, what's the biggest tool of money creation? It's not the Fed. You hear about them doing quantitative easing and everything and printing money. That doesn't make it into the system. The real money creation comes from the banks. All these banks work together in a coordinated effort. When they make loans, and they're making loans out, they're creating money. Even credit cards create money. They issue a credit card, that money doesn't exist. You go out and you make $1,000 purchase, put it on your credit card, now that money is sprung into existence. That creates money. Loans from the banks creates money. This is the biggest money multiplier there is the banks lending. And, they've went through a period now where lending has been kind of dry. And so what happens with a deflationary spike event? The alarm bells all go off. Ding, 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 ding. All of these, the central banks, not just the central banks, but the whole structure of the banking system, the alarm bells go off during an event like this when the market starts to drop precipitously big drops. That's what happens. It's that reaction that turns everything around. Now, see, we saw this rise in the price of commodities just recently, especially gold. Gold took off like a rocket. That was I've been waiting for this spike event. I know it was coming. I think this is it, guys. I think this is a spike event. I'm not quite sure. Like, if we see the market start to rally back, this might not. I'm not going to sit here and say this is the spike event until I see just a little bit more. I'm sitting back and I'm saying, hey, this very well could be it. Next few days is going to tell me, like Monday when the markets open up next week, what we see the markets do next week is going to tell me an awful lot more whether this is actually the spike event. Because the spike event has to be strong enough, number one, to cause a sudden reaction by the central banks in accommodative monetary policy. It has to have that potency. This is not quite the potency I'm looking for. Now, we see next week, if we see the market shed a couple thousand more points next week, that's the kind of action I'm talking about. That's what we need to see to say, okay, this is the spike event. Now there's going to be emergency reaction like what happened in 2008. You know how they propped the system back up. But back then, that was a different animal. The United States wasn't in debt like it is now. Their debt was less than half of what it is now. And they had an awful lot more room to do accommodative monetary policy without sending the system into the inflation. Now we're totally different. The inflation's coming anyway because of all these tariffs and stuff. That's going to jack prices up. That's going to bring inflation home. That's going to bring dollars back, are going to come back into the system, and they're going to be chasing goods and services. Prices are going to go up exorbitantly. So we're already on the side of what's going to be high inflation. Now, you take a deflationary spike event, add it to the mix, and then have the banks come in with accommodative monetary policy on top of that. What comes on the other side? Yeah, the markets will bounce back with the accommodative monetary policy, just like we saw in 2008. Sometimes there's a little bit of a delayed reaction in the markets. But when they start, if they have to go back to quantitative easing and scrap the quantitative tightening, and if they have to go back to lowering interest rates back down to zero again, and maybe even below zero, and other tricks and things that they can do, supporting the banking system, making it so that the banks, and they control this too. They control, through the banking system, they have almost like a lever and a gauge. They can turn that gauge up so that the banks will start lending money again. And they'll do that if they have to. We will actually see the initial stage of a hyperinflation probably within 6 months of them curing the problem, which is this downturn that I've been waiting for ages that I call deflationary spike event. When that changes direction on the other side, we could actually really go into the initial stage of a hyperinflation, which is called the acceleration phase. You've never seen inflation like that before. And that's where I really think we're going, guys. And on the other side of that, commodities are just going to take a moonshot like you never seen before. I know today we see commodities get smashed, you know, along with the markets and stuff. This could be it. This could be the big one. But we're going to have to see it through and see what it transpires with it. I've been calling for this for a long time. I really think this is it. I think this is our deflationary spike event. Really, guys, I think this is it. And if I'm right, if this is it, and we see the accommodative monetary policy to get us out of this mess, because that's the only tool they have at the Fed, is to create more Federal Reserve notes, add them to the system to prop the system up, get it functioning properly again. Then on the other side of that, we're going to see unreal inflation. And at that point, it trips another switch. That is, confidence starts to be lost at that point. That's when the confidence starts to be lost. And if you think that you've seen them running into commodities to try to find a safe haven in a storm, in particular the safe haven commodity, the ultimate safe haven commodity, you ain't seen nothing yet. And you remember all those shows I did in the past? I was telling you, okay, it's going to go to this price and this price and this price. And you had to wait so long because we've been waiting for this event. The deflationary spike event has to take place first before we can go into the massive amounts of inflation. And if you're not on the right side of this trade, when this gets finalized and gets done and everything else, and all the dust settles, then you're really going to miss out big. And you know, I mean, I've stated this before, that somebody who has non-dollar denominated assets and another person, if their currency is hyperinflating, I mean, they could have $100,000 in the bank. And if a currency is hyperinflating, the gasoline to drive to the bank is worth more than the money in the bank at a certain point. This happened. I mean, this is hard to get your head around, guys. I know this is hard to get your head around, but it's happened before many times. You see the pictures of Zimbabwe and holding up a sign, starving millionaire, and a guy, he's got like $10 billion in Zimbabwe bills, and he's holding them on a poster board, and he cannot buy an apple. He's starving. Well, just a few years before, those dollars might have been comparable to United States dollars. Now he's got like 5 billion of them. They ain't worth nothing. That's what hyperinflation can do. In Weimar, Germany, they were sweeping the bills up. It took a whole wheelbarrow load of bills to buy a loaf of bread. And they are so worthless that people were just leaving them lay on the street, all over the street, the German marks, which a few years earlier, just a very few years earlier, were worth like you could buy anything you wanted with them. And now they're totally worthless. They're just like leaves, a big pile of leaves in your front yard. That's how much they're worth. And if you think there's anything more backing the dollar than that, there's not. And they've been pushing it to the limit. They've been pushing it and pushing it. They've eroded 98% of the purchasing power. There's only 2 cents left. What happens when the confidence is lost? You cannot get it back. Nobody will want those things. I know right now they're the most desired thing on earth. Everybody's working for dollars here, there, everywhere. It's, I gotta get dollars. I gotta get dollars. But you're gonna need more and more of them, and in the end, it accelerates. It's on an exponential function. In the end, it gets worse and worse. 1%. You might lose 1% of the value of the dollar a day. 6 months later, it might be up to 50% of the value per day. And 6 months after that, it could be like it was in Germany. I heard a story that a guy bought a bottle of French wine, which would be rather expensive that night, and he drank it. And the next morning, the bottle, empty bottle, was worth more than he paid for the wine the night before. That's how quick it was losing value, the currency in Germany. This could happen again. It's happened before many times in history. We see it coming. I've seen it coming for like 7 years. I've been telling you guys this is coming. But I've been telling you guys up front, we need to get through the deflationary event first. That's the trigger. You cannot fire the bazooka unless you pull the trigger first. You have to trigger the hyperinflation. It's the deflationary spike event is the trigger, because they've got it all primed and ready to go. And then the deflationary spike event makes it so that they just do that final bit of stimulating everything when the system can't take any stimulus anymore, because it's already into an inflationary mindset. So they do the stimulus, and it's just like pouring pouring water on an oil fire. That final stimulus after the deflationary event. And they can't do anything else, but they're trapped, because if they let the deflationary event continue without doing something to slow it down, it would cause a depression. So what we're seeing right now, if they don't do nothing, if this is the deflationary spike event, the markets will continue to roll down until we reach depression territory, and the banks start to collapse. And then that spirals out of control and it gets worse. So they have to do something. So they lower interest rates, go back to quantitative easing, et cetera, et cetera, et cetera. And that's just, at that point, you've went one step too far. You've reached the edge of the cliff, and you've taken that last step, and now you're heading to the hyperinflation, and there's no way back. And that's where we're at right now. This is the final end game, if this is a deflationary spike event. We'll know this week, because if we could see these markets continue to roll down this coming week, and they can't seem to stop them, then they're going to panic and they're going to do the stimulus, and that's going to be the last straw. We're off to the races then. We're off into into the initial stages of a hyperinflation, the acceleration phase, where you're going to see like 50% annually of inflation. That means daily you go to the store, say you're going to buy a can of beans, and say right now it's $2.49. You go the next week and it's $2.75. You go the next week, it's $3.25. That kind of inflation. It really bites. And that's when the people are going to get upset. All the people in North America, if they get that kind of inflation, they're going to lose it. They're going to lose it. And they're going to require of the government more, because they're going to be like that show with he says, please, sir, what was it? I'm trying to think of the name. That was a great story. If you guys haven't watched it, I can't think of the name. It says, please, sir, can I have some more? England, they've went through periods were really rough, really hard times. And why can't my brain think of the name of that? Anyway, listen, thank you guys for listening to this show. And imagine that. The Dow is down 2,231 points today. Yeah, it was well over 40,000. Now it's 38,000. When's this thing going to turn? Now, there's another thing, too, guys. If you can find the bottom of this, it's going to do something very similar to what it did at the beginning of the COVID crisis, when we had a very sharp market downturn. Okay, take a look at this. Right, it was right here, I think, and it went down to 20,735. at the beginning of COVID. We had an awful steep correction in the markets, and the people that bought in right at that bottom right there rode it all the way up to here. Man, they did good. And so we get that downturn again. Where do I think it'll go? I think it's going to go possibly. I think now if this is the deflationary spike event, I think you're probably going to see it. It might break below 30,000 before this is done. Before they can get in there and stimulate the thing and get it turned around again. Maybe even 28,000. If this is a deflationary spike event, then if you buy in it, if you can find that bottom, and that's tricky, and buy in, you're going to do just as good as the people that bought in at the bottom during the COVID crisis. They did fantastic in the market because it's going to do this. It's doing the same trick all over again. Markets do extremely well in a hyperinflating dollar. But the thing you got to remember is even though the markets are going up daily, your dollar's going down. But it's better than being in savings. People that are going to get slaughtered in this are going to be the people who have savings in dollars. I mean, it's just going to be like absolute nightmare. It's because what you can purchase with them is going to go down so quick. That's why people are going to get out of them at that point. And we've already seen a bit of a craze, a bit of panic buying into the commodities. That's going to go off the scale nuts. That will. If this is a deflationary spike event I've been talking about, and if this continues and they have to do stimulus and stuff to bring us out of these doldrums, it's just going to be nuts. And if this is not the deflationary spike event, well, I'll still be waiting for it because I know it's coming. I know it has to be the trigger. So you guys have a great weekend, and I'm going to be on Sunday, and I'm going to be talking. I might not be talking about this because I talked about it here. I might be looking at more at the world events that's going on this Sunday out there, and there's plenty of them going on. I mean, we're getting so close to other things that are very, how can I say it, really nasty. I consider war nasty. It's the nastiest thing that mankind does. It's so stupid and so nasty and so awful. And how do we get involved in it all over again and again and again? It's just, who are we going to learn to get off of that? Anyway, okay, we'll catch you guys later and catch you Sunday. Bye-bye.